Welcome to The Intelligent Investor on YouTube. In this video, we'll be discussing the basics of investing, including stocks, bonds, and mutual funds. It's important to note that this video is for informational purposes only and does not constitute financial advice. Please consult with a financial professional before making any investment decisions. Now, let's get started. Part 1. Stocks. When people think of investing, stocks are often the first thing that comes to mind. A stock represents a share of ownership in a company. When you buy a stock, you are essentially purchasing a small piece of that company. As the company grows and becomes more profitable, the value of your stock may increase, leading to potential financial gains. This is why you should invest in stocks. One of the primary benefits of stocks is the potential for growth. Over the long term, the stock market has consistently outperformed other asset classes, such as bonds and cash. This means that investing in stocks has the potential to generate higher returns than other types of investments. Diversification is really important when investing in stocks can be an important component of a diversified investment portfolio. By owning a mix of stocks, bonds, and other securities, you can spread risk and potentially increase your chances of achieving your financial goals. But stocks are not only for people that invest long-term. You can also get money right now because some stocks pay dividends, which can provide a steady income stream. This can be especially appealing for those who are retired or looking for a way to supplement their income. Investing in stocks can help you have tax-efficient returns. If you hold your stocks for at least 1 year before selling, you may be eligible for long-term capital gains tax rates, which are typically lower than the tax rates applied to short-term gains. You'll be able to keep a larger portion of your investment returns if you hold your stocks for the long term. Another potential advantage of stocks is the potential for compound returns. When you earn a return on your investments, that money can be reinvested, leading to the potential for even greater returns over time. This is known as compound interest. Compound interest is the interest that is earned on an investment's principal and any accumulated interest. In other words, it is the interest that is earned on both the original amount of money invested, the principal, and any interest that has accumulated over time. For example, let's say you invest $1,000 at a 5% annual interest rate. At the end of the first year, you will have earned $50 in interest, bringing your total investment to $1,050. If you leave the $50 in interest to accumulate, it will begin to earn interest as well. So, in the second year, you will not only earn interest on your original $1,000, but you will also earn interest on the $50 in interest that you accumulated in the first year. This can lead to significant growth in your investment over time. Compound interest can be a powerful tool for growing your wealth, but it's important to note that it requires patience and a long-term perspective. It can take time for compound interest to have a significant impact on your investments, so it's important to be patient and stay the course. However, stocks also come with inherent risks. Indeed, there are 4 major problems with stocks. Market risk. The stock market is subject to fluctuations due to a variety of factors, including economic conditions, company earnings, and investor sentiment. This means that the value of your stocks can fluctuate greatly over time, and there is always the possibility of losing money. Company-specific risk. When you invest in a single company's stock, you are taking on the risk that the company may underperform or experience financial difficulties. This can lead to a decline in the value of your investment. Interest rate risk. Changes in interest rates can affect the value of stocks. For example, if interest rates rise, the demand for stocks may decrease as investors seek out other investments that offer higher returns. Inflation risk. Over time, the purchasing power of money tends to decline due to inflation. This means that the value of your investments may not keep pace with the rising cost of goods and services. Liquidity risk. Stocks can be more difficult to sell than other types of investments, such as cash or short-term bonds. This can be a problem if you need to sell your stocks quickly, as it may be difficult to find a buyer. One potential risk of investing in stocks that is not well known is the risk of fraud. Unfortunately, there are individuals and companies who may attempt to defraud investors through the use of manipulative or deceptive practices. This can include things like insider trading, misrepresenting the financial health of a company, or manipulating stock prices through the use of false or misleading information. To protect yourself from the risk of fraud, it's important to do your due diligence before investing in stocks. This may include researching the company and its management, reviewing financial statements and other public disclosures, and seeking the advice of a financial professional. It's also important to be aware of the risks inherent in the stock market more broadly. As mentioned previously, the value of stocks can fluctuate greatly due to a variety of factors, and there is always the possibility of losing money. It's important to carefully consider your investment objectives and risk tolerance before investing in stocks. Now that you know how stocks work, let's see how you buy them. You start by opening a brokerage account. In order to buy stocks, you'll need to open a brokerage account with a firm that allows you to trade securities. There are many different brokerage firms to choose from, and each one has its own unique set of fees and services. It's important to do your research and compare different firms to find the one that best meets your needs. Don't worry, in today's modern age you can do it on your phones on apps like Wealthsimple, Merrill Edge, TD Ameritrade, and JP Morgan Self-Directed Investing. The next step is to choose your stocks. Once you have a brokerage account, you can begin choosing the stocks you want to buy. There are many different ways to go about this, including conducting your own research, consulting with a financial advisor, or investing in mutual funds or exchange-traded funds, ETFs, that are professionally managed. Once you've decided on the stocks you want to buy, you'll need to place an order with your brokerage firm. You can typically do this online or over the phone. You'll need to specify the ticker symbol for the stock you want to buy, the number of shares you want to purchase, and the price at which you're willing to buy the stock. After you place your order, it will typically take a few days for the trade to settle. This means that the stock will be transferred from the seller to your brokerage account. Thank you for watching. If you enjoyed this video, don't forget to like, comment, and subscribe to not miss my upcoming videos.